G'day everyone, welcome back to another unique episode of Spark Your Fire podcast today. When I say unique, it's very rare that we have two guests on at the same time. But the reason why we're bringing two guests on, and over Skype as well, by the way, because the lockdown restrictions still apply. So we're seeing each other virtually, digitally over the Skype cameras, which is as good as if all of us are actually in the same room. But back to why we're bringing on two guests today is for our listeners or for any experienced investors, I'm sure they've read a book, a really good educating book called Property versus Shares, which is published back in about 2013, done by two excellent scholars, Peter Koulizos as well as Zach. So, that was an interesting book that was intriguing back in the days. I read it. Certainly, Jazz, our co-host, has read it as well. He's got it right in front of him at the moment. It's a shame that we couldn't show you, but but he has got it in front of us. And given the fact that it was back in 2013, we thought in the current environment, and this is 2020 now, it's only been a few years after, it would be good to bring these two people back on the show to do another match about property versus shares in the 2020 environment with a bit of COVID-19 on top as the cream on top. So
nice mix.
Yeah. So look, without any further delay, I guess we'll get the two guests introduced. So we've got Peter Koulizos. Peter, welcome back.
Thank you very much. Lovely to be back.
Always. Good to have you on the show. And we've got Zach Zakaria from Central Wealth Group. Zach, how are you?
I'm well. Thank you very much, guys, for the invitation to go another round with Pete. I always value that.
We've got the gloves ready for you guys, mate. Just
Excellent.
And we're not forgetting our usual lovely hosts as well. How are you doing, mate? In Melbourne?
Yeah. You almost forgot me, mate. Just
one in Melbourne, mate. I always leave the best to last. Let's put it that way. Do you need the red carpet as well?
Like it. Welcome everyone to the show once again. Thanks, Zach and Peter, to jump on. It's a very interesting environment that we're living in currently, and we like we were talking before. We had Peter on the show last week, and we haven't published the episode yet. The date of the recording today is 24th April. But Zach, I want to jump into gear with you first. Basically, I just want to see what your thoughts were on the current macro environment of what's happening. I mean, virus is one issue that we are facing, the health issue on one front, and then there's the other side of it, which is the economy, and we are seeing the unemployment number rate shooting up. I wonder what it means for the investors from an investor's perspective. How would you frame the current environment, basically?
Yeah, well, that's a great question, and it's obviously something on everybody's mind. The starting point to answering that would be to always remember that the share market has already factored in what it knows and what it thinks, at least for the next 6 months. And as such, it always leads the economy, right? So in essence, when the virus when the market kind of got wind that the virus was going to take an impact on the economy, that was around that sort of late February mark. And that's when, I remember distinctly that Monday when the market fell 7% in the day, right? Now, whatever that catapult or the catalyst was that caused that to happen, it was a realization that, okay, this thing is going to be bigger than just, being contained to China, for example. So effectively, the market now has dropped, upwards of 30-odd%, let's say, on average. I mean, I know we've rebounded in the last few days. The reality is it's already factored in a economic slowdown, if not decline, of at least 6 to 7%. And it's interestingly enough, when you try to work out, well, is that enough? I mean, the way that I've tried to kind of justify that to my clients as well, to say, well, is the market fairly valued now? Is it likely to go further? Remember, the market is the perception of the collective of a lot of people. So in other words, it's not wrong. It is what people are feeling and thinking right now. what happens with shares, though, it's also a very emotional beast, right? Because there is so much emotion in it, and also the mechanics of things like people having to trigger margin calls, which is a topic unto itself, and that obviously drives prices a little bit further. It is very much like a pendulum. So in other words, the pendulum might have swung too far to the downside now because of, you know, the emotions, the margin call triggers and those kind of things, and just that fear factor, right? The question is more whether we've seen the capitulation yet. And the capitulation is when the last of the people that are scared have sold because they can't handle the pain anymore, or they've been forced to sell. Now, there are certain triggers or indicators that we look for, but let's just go back a step there and look at the impact of it. So the market has fallen by that 30% level. On an average year, you know, in our book, Property versus Shares, we work out that shares have historically, over time, and I'm talking, you know, 30, 40, 50 years, consistently they deliver between 8 and 10% per year. Right. So if we've fallen by 30 odd percent, effectively that's 3 years worth of economic growth that we're saying, you know, is written off. So then we look at what, on an average year, the global economy delivers. And it's typically around that 3%, right? So again, 3 years of economic growth, if the share market is correct, is about, what, 9%. So effectively, the share market is factoring in that the economy globally and in Australia will fall by around about 9 or 10%. And that's kind of what the economists are saying right now. Whether they're right or wrong is going to depend on how long this keeps dragging out. But I think at the moment, the market's factored in that we are going to be like this for at least the next 6 to 9 months. And that's I guess, the price to be paid for it.
Right. Okay. So, so you are saying is the final capitulation hasn't happened yet. Does that mean that we'll see that the market will drop further from the bottom that it saw a couple of weeks ago in March, or it's already seen the bottom and we may see a little bit of a drop but it won't be any lower than what we have already seen a couple of weeks ago?
Look, I'd love to say that the capitulation happened. Capitulation happens usually when there's a massive amount of volume to the downside. And if I just pull up a quick chart of, say, our market, you know, yes, there was a lot of volume in the lead up to that low, and I'll tell you exactly when that low was. If I just pull up this chart over here, there are a lot of pundits though that are saying that we haven't seen the bottom. But in my view, on that day, the 20th of March or 27th of March, sorry, when we actually in that week where we made that low, there was a massive amount of volume, almost 3 times the average amount of volume. That is always an indicator to me that, you know, it's kind of like when you're, again, you know, I don't want to make an analogy to something violent, but let's say shooting a gun, right? If you're shooting a gun by pressing the trigger one trigger at a time, right, you're shooting, right, your bullets are coming out consistently. But then when you just literally squeeze the trigger and all your bullets come out, there's nothing left in the chamber, right? Just to make that analogy. So looking at that seems to be what's happened on that week of the 27th of March. And that's when we basically hit the bottom of, 4,400 in our XJO, the top 200, and then started to rally up since then, almost 1,600 points. So, you know, I would like to think that that is the bottom. And based on the current available data, the fact that there's a potential vaccine in the works, it could well be. We're also seeing, obviously, the number of new daily cases in Australia starting to taper off, which again is another positive. And my personal signal, I guess, from an investment perspective, to know when we've reached the bottom is when toilet paper gets back on the shelves. And I read an article today that you're going to start seeing a lot more of that. So, you know, the optimist in me says, yes, we've seen the bottom. But of course, you know, the market being fluid, it always reacts to new information. And all we need is, you know, the virus to basically start, you know, going again. And I did read an article overnight that there was a new city in China where there was a student that came over from New York, of all places, who has suddenly started to show positive for corona. And that potentially means the whole city has now been placed in lockdown by the Chinese government. I think it's called Harbin, the city, or something like that. But that's one aspect of it. I guess the difference, because there's a lot of people that are saying, this could be another 1929, the Great Depression kind of thing. What makes this very different is that in 1929, every country kind of was left to their own devices to manage this, to manage their stock market and also their economy. Here, we've got a global coordinated effort. I mean, you're seeing, yes, the similarities are definitely there. They shut down borders and those kind of things. But here, what we are seeing is a massive amount of stimulus that governments around the world are literally printing money, and they can print as much money as they want. It's more a question of, have I got enough ink and paper, right? Whereas back in the 20s and 30s, it was all about, well, I can't print more money than the amount of gold that I have. So if I've got 100,000 kilograms of gold, whatever the value is of that gold is how much I can print, and no more. So there was a finite amount of support, I guess, that governments could do. Here, and hats off to Scott Morrison. As much as people hate him, he's really been, I think, the best possible leader we could have had, without getting too political, to manage us through this process. That yes, there's always going to be critics of some of his policies, but I think the reality is people want confidence right now. This is a crisis of confidence as well as a financial crisis. And I think he's starting to give that. As money starts to flow into the economy and people start to feel, okay, wow, we can actually pay our employees, we don't have to get rid of them. I think that was the game changer for us. Had that not happened, you would have seen our market go even further, in my view. So the impact then, I guess, is going to be on those companies that don't make it. And, the classic is Virgin Atlantic. See, what happens in the background with these companies is they are funded by not just banks, they're also funded by bonds. So effectively they issue corporate bonds to, people like you and me, who typically would buy bonds instead of shares because of the fact that they are seen to be safer. Okay. Now, there's a school of thought there that says the ultimate of safe is a government bond, because technically a government should never go bankrupt. A corporate bond is, I guess, a little bit stronger than buying shares, because bondholders will typically get paid first, as you know. But the reality is those bondholders, if Virgin goes under, are going to lose their money. Now, in the global financial crisis in 2008, a lot of the collateralized debt obligations, which were basically mortgages that were then on-sold and repackaged and then, leveraged up, were then on-sold to other financial entities and so on. That's what created the financial crisis, all right? Because it was a big house of cards that came tumbling down. So the question is, these corporate bonds that are out there, and certainly, you would never have classed Virgin as what we call a junk bond. Okay, it would have been rated a AA, AAA at least. So investor quality. If those sort of things start to fall, the next question is, well, who's basically on the line for that? Who are these entities other than the mums and dads who have suffered? And that then creates a bit of a catalyst to another crisis. So, there's this thing brewing in the back there that is, the longer it goes and the more of these companies that do fail, my only fear is that there's a potential corporate bond bubble that's about to burst as well. But in saying that, we have to deal with the matter at hand. I mean, I'd love to say this is exactly what will happen. No one can positively say that. But as an investor, all I can do is manage risk, right? And at the moment, the risk that I'm managing for clients is a cautious approach. If you've got money to invest, we're basically staging our entries into the market. We're not going all in. And we're just really assessing it on a week-by-week basis.
Right. Okay. So this is interesting, Peter. I really want to bring you in onto this one. Let me define this first. So I call, at least in my words, I call a recession that is where the share markets drop by 30 to 40%, right? A greater recession, which is 40 to 60%, and a depression when we are in above 80%, right? Do we see this as a depression? Do you think it's going to be a depression? And how it's going to property market?
No, I don't see it. There will be a correction. Like what we've heard some people that want to grab headlines have said the property market's going to drop 30%. CBA, the Commonwealth Bank of Australia, came out with 10 to 20%. I think it'll drop 5 to 10% in price because, number one, interest rates are really low. So there is no need for people to sell because they can't keep up the mortgage repayment unless they have lost their jobs or lost a lot of hours in their job. But if they have, for the first time in my lifetime, the banks have brought in a mortgage holiday. Now, it doesn't mean that you don't pay that part of the interest off. It just means that you pay it later, but it certainly helps with your cash flow. So those two measures, plus the other one where we are strongly encouraged to go from principal and interest to interest only to alleviate our cash flow. I think from a financial perspective, there is no reason for property prices to drop that far. And from an economic perspective, there will be less demand from people looking to buy property, but correlated with that, there will be less supply. People aren't interested in buying property. People aren't interested in selling their property because both sides of that equation have more important things to worry about, and that is their health and also keeping their job or looking at a plan B. So demand and supply will drop. What will take a hammering, I think, is the rental market. Because in the rental market, demand has dropped, not many people interested in renting property, but supply is increasing because all those people that have short-term accommodation, in particular Airbnb, with the travel ban, nobody's staying there, so they're going to bring that onto the long-term rental market. So for rental, we've got drop in demand, but increase in supply. And personally, I'm already feeling that with not being able to rent property at the same rate as we were, say, this time last year, and it's also taking longer to rent. But from a personal perspective, even if I wanted to sell, I wouldn't because it's not a good time, and I don't have to. Because the worst comes to the worst, I say to the bank, look, can we please put my mortgage repayments off for 6 months?
Yeah, but that's a temporary thing, Peter. I mean, if you look at it, how long the government will go out for JobKeeper and job seeker package, right? Because that's the one that's holding on to people's jobs at the moment, and at the same time, the mortgage suspension has been done for 6 months. As the economy start to open up, there's going to be job losses here of within the vicinity of 10 to 30%, whatever that number is. And if the number is going to be that high, and at some stage the government is going to pull the plug on the JobKeeper and job seeker, whenever that happens, unless we literally go like Zach said, that it's unlimited money, we just keep printing, then the whole equation changes completely. It has to at some stage it has to be taken into account.
One of the differences is, and we might talk about this later on, is that property is illiquid. Like you can't sell it straight away. So it's very hard to panic selling property, unlike the share market. So what we will see in property prices may only drop by 5 to 10%, but transactions might drop by 50%. And the price doesn't show that. Yeah. So what we'll see is people in real estate who survive on transactions, real estate salespeople, real estate agents, conveyancers, mortgage brokers who base their business on only new mortgage, they are certainly going to be hit. But a price in property, like anything else, doesn't come along until they agree, the buyer and the seller agree. Well, if the seller is in no urgency to sell because, they got the backstop of the 6-month holiday or interest rates are only 2.5% and I can go from principal and interest to interest only, they just won't sell. So, and that's a saving grace for property at the moment.
So how do you take that, Zach? I mean, we saw that ASX dropped by roughly about 30%, right? I think the figure was about 38% to be more accurate. And in between the ASX, if we look at the shares of REIT Trust, even they dropped by, I think, David, the number was around 60-70%. I shared the charts with you on some of them. And but when you look at the actual physical real estate, that hasn't dropped so far that much, like Peter said, and it won't drop any more than 5 to 10% according to Peter. And even if we take the worst case scenario that some of the economists are coming up with, it looks like 20% is about the number over there. How would you digest that information? And for the listeners who are listening to this, what's the best approach?
Well, I guess it's firstly understanding what makes up the REITs, the REIT sector that's listed on the market. It's not the mums and dads properties that Peter's talking about, that you and I live in and so on. It's basically companies that either do property developments or companies that are owners of offices and industrial warehouses and whatnot. So those are the kind of companies that are listed. And again, being an equity, right, the first thing people are going to do is sell. So that pendulum effect that I was talking about before, that's obviously taken hold into that market too. And I guess the key worries, as Peter alluded to, is the fact that unless you have to sell, right? In other words, who's going to make you sell? Well, your financier is going to make you sell. All right. And you're going to be forced to sell into a market where, well, let's face it, there's not going to be many buyers anyway. It's not in anyone's best interest to do that. So it's more an accommodative type environment. So the companies that have really taken a battering in the REIT sector are the likes of the Westfields, because all of a sudden, guess what? They have to give rent relief, right? So it's a factor of profitability more than anything else, more than values, because ultimately that's what a price is valued on, a share is valued on. It's capacity to earn profit for its investors. So the likes of your Westfields have been battered. What else have we got there? We've got the companies that do like Mirvac, developers and those kind of things. Yes, they've got pipeline work, but what's coming, right? So investors are taking a worst case scenario approach. Well, things are going to slow down. Profitability is not going to be there, blah, blah, blah. Then, of course, you've got others who are office holders, much the same. We've got clients who are invested in several of those great companies like Cromwell Property Group, for example. They've got governments as their tenants, so you would think that would be okay. Even they've taken a battering. So when you're looking at the property market, you really can't use the REIT sector in the share market as a proxy for it, in my view, because it's got more of the characteristics of a share than it does of property. Property is a very different beast. I had a discussion with a fellow investment advisor about this very topic, and he's got friends who own very very big shopping centres, not just in Adelaide but around Australia. And the reality is that as Peter would allude to you, is that the valuations of these properties are based on the amount of rent you're getting, right? So you reduce that amount even by 20 or 30%, all of a sudden the value of your property has dropped. Now, a lot of them have got covenants with their banks to maintain a certain LVR for their lending. So all of a sudden, on paper at least, you've got a $300 million shopping centre that's on paper worth maybe $200 million, and they've got loans of $200 million. Well, that's the point that I was getting back to there. It's a case of, does the lender then force them to sell that property? I wouldn't imagine they would, because it wouldn't be in their best interest, because they wouldn't be getting $200 million anyway. So I think in the short term, it's just going to be a case of monitoring those number of new daily cases. And as we are seeing, if that curve has started to flatten and we can see that there's an end to this, it will be more of an accommodative environment for everybody. And, those people that, as Peter said, do have to sell in the property side, well, they will. And, they'll take whatever they can get. My figures that I'll keep an eye on is the jobless numbers, absolutely. And, even in our business, we're seeing our clients are just not willing to do anything because no one's sure if they're going to have a job tomorrow. And, and confidence is what we need. We need confidence to come back, both from businesses, because they'll keep people employed, and then obviously the consumers, because they'll then start feeling confident to invest or spend or whatever.
But then one of the things with this virus is if we look at it, and especially in Singapore, this happened a couple of days ago, where they've diagnosed a lot more cases, about 1,400, 1,500 new cases, right? So it's pretty safe to say the vaccine for this thing is not going to be out to the masses for at least next 15 to 18 months, right? And that's a fairly long period of time when we look at that. And that means all these small businesses that are there, they won't be able to open up their shops, or they'll have to maintain a social distance, which means if a restaurant opens up, 60% of the capacity of the restaurant will be reduced just to maintain the social distance, right?
Yep.
So, which means this is going to go on for a prolonged period of time. For at least it's fair to say at least next 12 months we are in this, and the small businesses are still going to be impacted, right? And then the question becomes is if the impact is, we know that the impact is there for that much period of time, right? How do you navigate this environment now of people who are thinking of investing, have got the cash sitting on the sidelines? How do they figure out when to jump into this market, both from Peter property perspective and Zach looking at the share market, right? So you said that the capitulation is yet to happen, but it hasn't bottomed, right? But how do we decide when to enter the market, the investors, basically, in this case? Is there any particular data points that you're looking at, or?
Do you want to go first, Pete, or do you want me to go first?
Sure, yeah. So there's no particular specific data points to look at, but whether you want to invest in property or whether you want to invest in shares, a lot of it's going to depend on your risk profile, because people are very scared at the moment. So the fact that money is really cheap if you need to borrow it for property is fantastic. But the key here is, how secure is your job? If your job is really secure, you might work for Centrelink or in the health industry, or you're pretty guaranteed that through COVID-19, you will keep your job and maybe even get extra hours, and you have an inkling for investing in property, then this would be a good time. Well, when I say this, not necessarily today, because I think property prices, as I said earlier, will drop a bit, especially over the winter time. But importantly, this is not a time to be dwelling in those really cheap suburbs. If there was ever going to be a time where you can buy into a top-class premium or up-and-coming gentrifying suburb, this is the time to get into it. Money is cheap. On average, property prices will drop 5 to 10%. Some individual properties will drop less than that, because some people will have to sell because they'll be getting divorced during this period, or there's a death during this period, or whatever it might be. Before we started recording this, we said that auctions are going to take a hit. Number one, they're online. Number two, a number of banks are withdrawing their unconditional approvals. So, but some people have to sell, especially if it's going for a public trustee. So I would be looking at the top end of the market to buy, but still buying the right property in the right street, in the right suburb, not just buying into any expensive suburb. For example, let's say on a main road in a premium suburb, I wouldn't be doing that. But my personal opinion is I wouldn't be doing anything until I started to see unemployment improve. I know that means that I missed the bottom, but, I'm not a genius. I don't have a medical background. I don't have the same background as Zach to work out when's everything going to hit the bottom. But when I can see unemployment starting to increase, then I know, because there is a close correlation between employment and confidence, then I know we've bottomed out. All right, I'll get in now.
Right. So your important point over there is look for the blue chip and don't wait for the bottom. Even if you miss the bottom, it's fine. Maybe jump onto the recovery ladder when you see that the recovery is starting to happen, which is one of the things is the employment numbers that you mentioned over there, right? Zach.
Okay.
Yeah, I echo that absolutely. Employment numbers are at least a month behind. Most other economic data is at least 3 months behind. So by the time you're waiting for that signal to happen, you've missed the bottom. And the reality is no one's going to ring a bell and tell you, hey, guys, this is the bottom or this is the capitulation. You just have to make the judgment call, as Peter said. It's all about managing risk. And it's understanding that you're in there for the long term. Now, the reason anyone invests is because they believe what they're investing in is going to have value in maybe 5-10 years' time. All right. The short-term type stuff is not really what we're talking about here. It's investing, and investing by its very nature means money that you can set aside, that you have an intention that it'll grow for you in 5 to 10 years. Now, the reality is, from the share market perspective, after you've had a 30 to 38% fall already, what's the probability of having a further 30% fall? You know, I guess it's a lower probability than actually seeing a rise. Okay, so from that perspective, it's a perfect environment to at least start thinking about buying. But then, of course, you have to be, as Peter said, with property, shares is exactly the same. You need to be very picky about what you're buying. I mean, would I be buying an airline stock right now? No, right? I don't think we've seen the bottom of that. But I can tell you when I will buy the airline stock is the minute that, government restrictions are lifted and people can start traveling again. That's absolutely when I would. Same with companies like your entertainment shares, the group that owns, Dreamworld and all that, Amalgamated in Queensland, right? Those guys will not be able to operate until restrictions are lifted. So literally, we are buying something now, if you buy it, that has no income. There is no business technically at this very moment. Yes, there will be a business, but the question is more, will they be able to survive until they can start running again? So we have to make that judgment call. So if you're looking for safety, let's say you've got cash right now and you want safety, I would be looking at buying the things that people absolutely need to live, right? Groceries, it would be, household products, toilet paper providers, right? I wouldn't be buying things like, Flight Centre and those kind of things, right? Because those, are not going to have any income. But things that people need, healthcare, that just haven't shown any declines, right? It's that kind of thing. You have to be really a good stock picker in this market, much like, as Peter was saying.
Yep.
But, the thing is this, it's about being prudent about buying something just because it's dropped by 70%. It's a question of, all right, it might have dropped by 70%, so it's a bargain. But the question is, will that business be around in 5 years' time? Or will it make it through to be around? So I'm more than happy to give up 10%, of potential growth because I missed the bottom for that potential that it's going to go up.
Right. So one of the things that we discussed with Peter in the last episode was, and he agreed that baby boomers took the cake and the icing on the cake, which is investing in the property used to be a double-digit number growth. And in the future, we probably won't be getting double-digit. It will be more like single-digit, and that too, you have to be very selective with the type of properties that you have to invest in, right? Now, you guys have written the book Property versus Shares, right? When you are selective with Zach with shares can see a very decent sized growth, right? You can see numbers in double digits without a doubt, right? I'm actually being a devil's advocate over here, Peter. I love property. I don't even invest that much in shares. But is it fair to say that property is in the future, unless you're doing some kind of a active investment strategy on it, is not going to be such a great investment vehicle?
So far as capital growth is concerned, Zach is right that, and when you look at our book, shares increase 8 to 10%. But what Zach didn't say was that property increases at 7 to 9% historically.
I was waiting for that.
Baby boomer times.
So it is a little bit further behind, but just to use your term, Jazz, yes, shares do have a decent growth spurt, but as we've seen recently, they can also have a decent downfall too, whereas property is a lot more stable. Generally, if you're more risk averse, property is probably a more suitable investment vehicle for you. And if you're the person that wants to see what the value of their asset is every day, and you might be prone to buying or selling without doing the proper research, then you're better off probably with property. Whereas shares gives you the option to sell very quickly if you want to or you need to. But, as Zach said, Virgin Australia, in theory, was a top-class company, but doesn't look so now. So unless you're going to invest in, say, like a managed fund or an indexed fund, which has a whole heap of companies all together, you'd want to do your research just like you do with property, because with property, you're not buying a portion of the property market, you're buying a property. So you want to make sure that property is the right property in the right street, in the right suburb, because so far as property is concerned, location is the most important factor in driving your capital growth. So you want to make sure not only do you get the macro location right, that is the city or the state, but the micro location, that is the particular street and part of street.
Right. Okay. How would you go with the shares, Peter? Oh, sorry, Zach.
Mm-hmm. Look, shares, I think, at the moment, I'm actually always very bullish about shares. I think they will rebound and they will continue to deliver what they've always delivered. And usually what you find, and I've done some interesting research on this, and I'm happy to send it to you to share with your listeners if you like. After all of these medical pandemics in the past that we've had, SARS, MERS, H1N1, all those, once we've reached the bottom, the market usually has double-digit rebounds. And it's just by virtue of the fact that the pendulum has swung way too far to the one side, and then it swings way too far to the other side, and then it kind of settles. And then the whole way that we reach that 10 to 12% per year is the fact that, you average these 38% drawdowns with the 55% rallies, right? So once you average all that out, it just means that you have to take a long-term approach on investing in shares to get those returns. Yes, you might be lucky. You might put some money down now, and then in a year's time, you'll say, yep, that was the right thing to have done. But at the time, you always need to manage that risk, as Peter said. You can't go all in on one stock, for example. I mean, you can do whatever you want, but that would not be prudent, because literally you're hedging all your bets on just that one stock, recovering and doing well for you. Whereas if you're buying a diversified portfolio, you get maybe less volatility, and you'll get those, that 12, 13%. But I think in the short term, yes, we will see some normality happen. And markets being what markets are, they are more volatile now than they ever were, and certainly a lot more volatile than property. It just means that, you got to have your heart medication close by.
A question then, I guess, because we're comparing property, which is more of a safe type of investment, versus shares, very volatile as we know, and therefore can fluctuate a lot. But what about, say, for example, in the current environment, would exchange traded fund and ETF would be a good middle kind of option, given the fact that it's a lot more diversified, it's not just single shares, and a lot of times, the investor doesn't have to do extensive due diligence into a single share to understand what the future prospect of that is like. And a lot of people may not necessarily have that time or the skill or the knowledge to be able to do that. So in that scenario, would an ETF, like, for example, a Vanguard, a VAS, or, a VGHS at the moment, would that be a suitable option for someone who's kind of middle in terms of risk type of appetite, want to try to dabble into shares, but not into just a single share? Would that be an option, Zach?
Yeah, absolutely. What I always suggest to my clients as a general rule is if you've got a low balance, let's say $100,000 or lower, and that's a lot of money, don't get me wrong, all right? Just being relative, of course, speaking, you would be looking at a diversified fund like that. There's plenty of good ones out there, and it just depends on the theme that you're trying to get exposure to. So we usually structure our portfolios with exchange traded funds wherever possible for those kind of clients. I mean, really, when it comes to picking individual shares, it does take a lot more effort and work and monitoring, because as you know, your money is literally tied to the fortunes of that one company. Whereas if you invest in the fund, then depending on the fund mandate, the fund manager does all that work for you. But ultimately, you need to remember that, an exchange traded fund is still investing in those underlying shares. So it comes down to understanding whether that mandate is that it's following an index, in which case it's always going to have the stocks of the percentages that make up the index, in which case whatever the market does, you'll get back as a return? Or is there an element of active investment management in there? In other words, there are funds that do option writing strategies. There are others that have a short, like, they short the market as well, like hedging. And they tend to try to outperform the market as well. So understanding all those elements is quite important. My personal view, excuse me, as a portfolio manager, investment manager for my clients, is that I take the approach of I'm a fund manager of funds. So in other words, we'll bring a fund in, which is a diversified fund or even a direct share, when we feel that the market is low risk or buyable. And then as the market starts to get to that point where it shows degrees of risk, where it's overbought, things are overvalued, not necessarily that there are pandemics in the wings, because you never ever will know about that. You start to lighten up on those. So then effectively you have this approach where you're taking as much of the upside as possible, and you're outperforming by not being on the downwave, if you know what I mean.
Mm.
Or being as little involved in that downwave as possible.
No, that's cool. I'm on to the page 279, which Peter hinted me to get onto to find the winner of this game, right? I know David doesn't have the book.
You already jumped the 278 pages, mate. Seriously.
Was there for a very long time, my friend. All right. So, capital growth. The first thing, right? Now, I want to touch on both the past and the future, right? So, if I look at the book, Capital Growth, the winner has been called Shears. Peter, you lost over there, right? Just by a
by a whisker. By a whisker there, Jazz. That's what it says in the book, mate. Just by a whisker.
Yeah. So is it fair to say that in future as well, the capital growth is, over the long run, Shears is going to be the winner?
Yeah, I think so. I can't see anything changing, the fundamentals changing. Zach, what do you reckon?
Yeah, look, I think, the data that we compiled was over a really long period of time. I think we went back to, early 1900s, didn't we, from memory?
Yes, about 100 years, yeah.
So it's not like we just looked at the last 10 years where, let's say, shares may have had a good run. Certainly it's just by a whisker. And again, it's hard when you're writing a book like this to say, well, all property, all shares. Because if I buy something like a Telstra, you wouldn't have seen capital growth that you would if you bought even an average property in an average suburb in Adelaide, right? So you have to take a broad brush approach. I mean, we used the index here, so the top 200 companies in Australia, and Peter used the median house prices around Australia. So if you look at Sydney in isolation, well, they would have killed some shares, right, in the last couple of years. Mm-hmm. So, but overall, yeah, it is similar. The thing that I must admit I cheekily did not include in my part of the book was this concept of risk-adjusted return. Have you heard that concept before?
Yeah.
So in other words, for those listeners that don't know, it's, let's say, for example, I've achieved 20% for the year. That's wonderful. Property has achieved 15% for the year, right? So on paper, shares wins. What you haven't realized is the roller coaster ride that shares took to get you that 20%, right? Which was a fluctuation of, let's say, minus 20%. Whereas property might have had only a fluctuation of minus 5%. So when you actually balance out the numbers, the risk-adjusted return is the one that you really should be comparing against. Now, I'm kind of shooting myself in the foot here because I think he's going to want a rematch, and he's going to do that, in which case he's won, right?
Yeah.
But yeah, so I guess the point to say is, yes, capital growth, we will probably, like when I say we, the share side of things, will still maybe slightly outperform as it has historically, but it's the risk-adjusted return we will severely continue to underperform.
Yeah. The next one is income. It's a draw on both the asset classes. So what we're saying is the dividends, if you look at some of the dividends from these banks or the big companies, are fairly similar to the rent return that you get on average, which is about 3 to 4% on a property. And that will remain same in the future as well?
Yeah, look, in the short term, obviously companies are not going to be paying the dividends that they have. So, and that's really what people are worried right now, that, you know, their safe bank stocks are not going to pay them their 5-6% per year. And, you know, you have to obviously put your hat on as if you're managing a company. Well, you know, if you're only earning $50 this year and last year you earned 100, well, you're not going to pay out $60 to your investors, right? So you're going to cut that down. So inevitably we're going to see cuts. But when you look back even at the global financial crisis, you know, I think the worst of the top 20 cut their dividends by 20-25%, something like that. Whereas their share prices fell by 55%. In this case, look, it might be very much the same in the short term, but I think longer term values and incomes and will go back up to where they were, which is that historical level of, you know, 4-5% or so.
Peter, you don't see deflation causing the rent yields to drop like we are kind of currently seeing in this environment, where the rents are negotiated again?
Because everyone needs somewhere to live, there's going to be less of an impact on property than there will be in the share market. Yields will drop because property price yield is the annual income divided by the price. The price will drop, but the annual rent will drop even further. So yields will lower overall in the property market, but not hugely.
Right. Okay. Tax effectiveness, again, both of them is a draw. Franking credits are great for shares. Depreciation is a winner for property. That will remain the same in future as well. Although there has been a talk about depreciation, the whole agenda that was there with the Labour Party last year to remove the tax benefits. So
they talk about franking credits as well. Yeah.
Yeah,
that's the threat, I guess. I mean, in saying that, you know, the franking credit argument, I think, is a strong one. You know, you have to look at why it was introduced at the first place. So, you know, the skeptic in me says that it'll probably come back onto the table, because if you imagine in 3-4 years' time, when we're looking back at, you know, at now, and the government is counting its pennies and saying, gee, we spent a lot of money, how are we going to get that back? I think that'll come back on the agenda to say, well, if we don't have to pay franking credit, you know, if we allow franking credits to go, we're not getting as much revenue. So, yeah, I you know, the negative part of me says we should enjoy it while we can.
Yeah. Degree of control, that's clearly property. That's
one of the things that I love about property, is that I'm generally in control. Not so much price, but again, price is dependent on the buyer and the seller agreeing, and I don't have to sell if I don't want to. But if I feel I'm not getting enough value out of my property, I can improve it and get better value. And yeah, like if the share market's plummeting, I can't do much about my shares. But so far as property is concerned, again, based on its illiquidity, I have a much greater degree of control. And that's probably my favourite bit of property over shares, is that I have a greater degree of control.
Yeah, I mean, unfortunately, I do have to concede that one, because, you know, if I don't like what Telstra are doing, for example, and I think that they should go down a different path, well, then my minute percentage shareholding is not going to allow me to make any drastic impact on the board, right?
Yeah.
But I guess the flip side, from a control perspective, the ultimate control is, well, if I don't like what they're doing, I can sell it.
Yeah.
So that'll be in the rematch, Pete. That argument.
Okay, mate.
Zach is getting ready. Volatility of returns. We've already talked about it. Property is much safer in that space, especially when you talk about risk adjusted. So we won't argue on that one. Frequency of returns. Property wins on that one. More regular income from property. I thought there would be a good fight on that one from shares perspective with the dividends.
Look, they tried. I'll be honest with you. They tried to put up a fight, but they were knocked down quite badly because of the fact that, like now, for example, you've got a company that's paying you a nice dividend, and then they have a bad result, and boom, it's gone, right? So fortunately for property investors, your tenant continues to pay. Well, most
you
of the
hope
time.
they'll continue to pay.
That's right. You hope.
This one is my personal favorite. Finance. Property is a big winner here, without a doubt. Leverage. You leverage your 100K to whatever 500-600K. Here's the question, Peter. Are you aware of any margin calls like that happen in shares, happen in property for small to medium investors?
Now, even when we had the mining crash and properties in mining towns had dropped significantly and people's mortgages were greater than the value of the house, I've never heard of a story of anyone being forced to sell their house, because really, like Zach made a good phrase before, it's in nobody's best interest to cause a crash in the property market and force people to sell. So the bank's thinking, well, providing you are making your mortgage repayments, then we are happy with that for now. And it would really probably be on the owner of the property if they had to sell because they were going through a divorce or there was a death. But no, I have never heard of a margin call of a property because what you owe on it is more than what the percentage that you own.
So here's the question. Isn't that unreasonable to have, and maybe Zach, you can answer that, shares obviously do see a lot of margin calls, right? Isn't that a little bit unreasonable with the property? I guess the answer is that it's not a liquid asset, so it's a little bit tricky and there's not much point. But if shares are supposed to get a margin call if they go below 50% or 40% or whatever the number is, why not do that with the property as well? I prefer that they don't do it, but
yeah, absolutely. Let's hope they don't get that idea in their minds. No, look, it's a case of, as you said, you touched on it. It's liquidity and volatility. Now, the reality is when you go in and get a loan for a property, they'll assess it, and the banks are conservative at the best of times, right? So they'll work out that a 20% buffer is more than enough, and if you go more than that, obviously, then you got your lender's mortgage insurance. So either way, the bank's protected. Now, the reality is this in the property market: the bank is only interested in the short term in the interest side of it, in making money off the interest. So, as long as you continue to pay, they're going to leave you alone in most cases, right? It might be a little bit different on the commercial side if there's covenants and that sort of thing with banks, that you have to maintain certain LVRs. But again, when you look at those sort of things, it's because the banks fear volatility, right? They fear that they don't want to be overexposed. So it's all about them protecting themselves. Shares, of course, well, that's a different kettle of fish because of that volatility. A margin loan is always going to have that degree of maintaining LVRs. And, even the most conservatively invested people on margin loans would probably been triggered. And that was what I believe caused that last push to the downside in March. But I guess, I can't ever see margin calls coming into the property side. And certainly not in an environment like now, because everyone's in the same state. Everyone's in the same boat.
Yeah.
So, as I said, banks assess their risk at the start and they make a judgment call to say, well, we think the risk in this suburb, in this type of property that you're doing is such that we'll have a very low LVR for it. And therefore, they basically then, make that judgment based on, serviceability and whatnot. And then as long as you keep paying your loan, they'll leave you alone.
Yeah. Okay. No, that's fair enough. Liquidity, that's clearly the shares is a winner. We don't even have to argue on that one. Property hands down loses on that. Holding cost, entry and exit fee. Again, there's hardly any to the shares. So there was, I'm assuming, no fight on that. Ease of getting started. This is an interesting one. Less money needed surely for shares, but is it that easy to get started on the shares?
Absolutely. Put it this way, you can open up an account with as little as a couple $100 if you want to. I mean, it does make financial sense to do that. But let's say you've got even $1,000, and I get this, from some of my clients all the time who say, look, my grandson's 2 years old. I want to open up an account for him. How much do I need? And it's a case of, as David was saying before, you would basically look at a nice diversified fund, and just put your money in that and just kind of let it sit and manage it, for the long term. We did that a few years ago for some clients. They started with a $2,000 account. We had a geared share exchange traded fund in there. Now, gearing obviously means there's internal borrowing within the fund, and it maintains its own LVRs and that kind of thing, so you never need to worry about it. But effectively, that little $2,000 portfolio went to $10,000 just before this correction, and now it's down to $7,000. You know what I mean? So, For the most part, it's a very, very easy way to get started. Especially if you go with one of the online brokers that charge you $10 brokerage. It costs nothing to get started and get a bit of a taste for it.
Yeah, that's a fair point. They are some of the main points. Information, I guess it says information. Shares is the one that's providing you a more reliable information. I totally disagree on that one. Peter, how did you lose that argument?
So, Jazz, tell me, where are you going to go to get really good, up-to-date information on property? Where are you going to go?
Real estate, RP data.
Yeah. CoreLogic is my number one source of information so far as property is concerned. But property data, because of its nature, is not current, because you're waiting for a property to settle before you get the real information, and that transaction may have occurred 4, 6 weeks or 8 weeks beforehand. So you don't get really timely information about that. Most of the people that deal with property are real estate agents. Unfortunately, real estate agents don't have the best reputation in the world. So, and there's unfortunately a lot of property spruikers in the property market. But maybe one of the issues with shares is there is so much information. What's trustworthy, what's creditworthy. That's why I lost it, Jazz. That's why I lost it.
Yeah. And the other thing is also, when you look at a property, you can't see behind it, what the balance sheet of the owner or the investor looks like. You don't know at any point in time what the rental yield is, what its expenses are. If there's maintenance issues, right? Your RP data is not going to tell you, hey, guess what? We just had to put a new water service in, right? Any listed share investment has to abide by ASIC's reporting requirements and the ASX regulations. And that means, quarterly updates. If there's anything material that changes with the business, they have to let investors know. So, as Peter said, the danger is too much.
But the counter argument to that is that information gets manipulated by the internal politics a lot too. So whether you truly get the timely, accurate information, like Peter said, is a question. Yes, property lags without a doubt, but you can find the right information, and that information will generally be accurate. Whereas with shares, that can be manipulated very easily.
Ooh, that's a bold statement.
I've lived the corporate world, mate.
Yeah, look, so have I. I used to be an accountant for one of the listed companies, and I know that it starts with the bottom down sometimes. Like what profit do we want this year, guys? And then the accountants have to make it happen. Look, I totally get that, but I guess the counter to that argument is that accounting standards have improved significantly, so there's less scope to get away with it long term now. You know what I mean? And theoretically, the auditors should be picking those kind of things up if they're any good. Look, at the end of the day, though, I guess it's the quality of information story versus the availability of information story, and then of course overlaid on top of that is the quantity of information. As you said, there's a lot of information. You just need to be smart enough to pick out, hey, these guys are telling me a lie here.
Yeah. Just before you go, Zach, Peter gave his 3 best burbs to invest in Sydney, Melbourne, and South Australia. Your 3 best share tips for the next 3 to 5 years?
Ooh, okay. Well, again, I come back down to basics, and it's things that we live and breathe and use every single day of our lives, and that will be around. And then also looking at how we will live in 3 to 5 years. Now, the big one for me is technology, right? So I'm very, very big on technology, whether it be the providers themselves of communication services like the Telstras and the TPGs, or the actual providers of software and things like that, and hardware components. There's just so much. So the best way to take advantage of that is through something, as David said before, with a technology ETF. So I'd be very happy to put a tech ETF in my portfolio, which covers that whole industry rather than having to pick one individually. Cybersecurity also is another variation of that, because obviously as technology evolves, the need for security is obviously going to be important too. And there's a great ETF from BetaShares. You may have heard of BetaShares as an ETF. They do a really good one there as well. So that's one theme. The other theme again is going to be food, and the third theme will be health. So providers of food, I think, are critical, and providers of health are going to be critical, health providers. And now on the Aussie market, you really can't go past the likes of your CSLs, but they are like $300 per share at the moment. So the next best one would be to find something like a Fisher Paykel Health. They've been one of my favorites in the last year, and they've held up very, very well. Food-wise, look, at the end of the day, you take a risk by buying a retailer, I guess, something like a Coles or a Woolworths, but they're a staple. They'll always be around, whether it be in online form or or physical form. So in Australia, that would be my preference. So Fisher & Paykel Health right now, something like a Coles, even a Metcash. Metcash is the group that owns IGA. We've been putting some clients into that, and a technology ETF.
Cool. That's really good. I appreciate your time, Zach. Peter, thanks for that.
Thank you both.
And I'm sure we'll be back soon again. But if you guys are writing the book, let me know. I'll join the party to debate on another subject.
Absolutely.
Next time will be property versus shares versus crypto.
That's right. It might be the dark horse that wins us both, hey, Pete?
We'll find out in the next 2 to 3 years.
Yeah.
Cool. Not a problem. Appreciate your time. To our listeners, hope you guys are enjoying the content. And if you are, please don't forget to give us a 5-star rating on iTunes or whatever app you're using, and let the word spread like a fire. Spark your fire. Cheers, Jazz and David. Bye.